hedge, that means in the future you're gonna purchase the spot. It all goes together. Okay. Now finally, before we go with a lot of story going on here, okay? So if you go on to short hedge, like you are the wheat farmer, let me answer your question. In October, you sell the wheat to me, right? I'm the bakery. So to me, the price you sold to me is a cost or is an income? Cost. You are the farmer, you harvest, then you sell your wheat to me, right? So to me, this is your income, right? Very important, okay? So this is your income. Every word I'm saying is meaningful because we have to come up with a formula later, okay? And then long hedge, me as a bakery, I buy the wheat from you. So to me, this is a cost, okay? All go together, all right? So far so good? Yeah? Okay, you understand what I'm saying, but you don't understand what I'm drawing. It's okay, we take time at time, okay? So if that's all right, just remember from now, trading strategy, hedging strategy have two, long hedge, short hedge, okay? Long hedge is constructed from the buyer, so it's a cost. Short hedge is constructed by the seller, so it's an income, okay? It all goes together. I did it opposite. Okay, the top is short hedge, so the bottom is long hedge. So here is okay. So this is the seller income, and that's the buyer cost. All right, so if that's okay, we take a long hedge first, okay? But before that, we want to discuss what is hedging. So take a look. All right, so first of all, long hedge and short hedge, I just explained to you, right? A long futures hedge is appropriate when you know that, did you see? I will specify the keywords. Long hedge, right? Goes together with purchase. Did you see? Okay, in the future, and you want to lock in the price. Here, please write down, this is the cost. Okay? And then a short hedge is appropriate when you know that you will sell something in the future. So that's your income. Okay, so specific terminology, the first one is long hedge. Second one is short hedge. Okay, 叫多单跟空单体现哈，你自己看。Okay, but first of all, why do you want to hedge? Okay, obviously you want to lock in the price, right? So you are able to lock in your profit, you are able to lock in your cost, okay? So companies should focus on the main business they are focusing, and then take steps to minimize the operation risk, okay? So as a consequences, they should hedge the risk, okay, apart from the sales, okay? So basically, your purpose is to lock in the price. Okay, this price could be your purchasing cost and could be your selling income, right? That's the key point for you to construct a hedging position. Agree? Okay. But some of the companies, they don't like to construct the hedging position. Okay, so their argument against the hedging. Okay, they think first of all, shareholders usually well diversified can make their own hedging decision. What does that mean? So in your portfolio as an individual shareholders, maybe you have all companies shares, but on the top of that, maybe you have other companies shares as well, like Google, like Microsoft, like TSMC. So you don't just have our shares, okay? So throughout diversify your portfolio, you're already hedging your risk. Okay, that's the main argument why we don't hedge. Okay. Secondly, it may increase the risk to hedge when the competitors they do not. Okay. So basically, if go against, okay, the direction, okay, no hedge, maybe more. Okay, so sometimes if your competitor they don't hedge and the interest rate actually goes down, actually they are borrowing at the lower rate compared with us, right? Because we lock in as a relatively high rate. It could be possible, okay? So when you construct your hedging position, first of all, you have to try to predict and analyze whether or not you should hedge, right? If the price direction actually go in favor for you, you don't have to hedge, okay? Unless the price direction goes against you and you will have risk in the spot position, then you can decide that you want to construct the hedging position to lock in the prices, okay? So explain situation when there is a loss on the hedge and again on the underlying can be difficult, okay? So what does it mean? Like the bakery, okay? You construct a long hedge in wheat, okay? But the spot wheat price actually goes down. So in that case, you don't have to hedge, right? Agree? As a bakery, originally you go on to loan the bakery futures. Maybe you loan at $80, okay? However, if in the future the wheat price goes down to $65, actually you don't have to hedge, right? You just buy 65 from the spot market directly. Can you guys follow me? Okay. So whenever you want to construct a hedging strategy, you have to first of all analyze and try to focus whether the price goes against you or goes in favor of you in the future. Okay? And then before you make the decision, well not, we should hedge, right? Okay. Now, the convergence of futures price, we know that already, okay? So, if the S is higher than F, remember what I just said? This is a inverted market, right? Okay, backwardation. Okay, and then, but in the end, they will convert it to the same points. Okay, and then remember another shape. You started with the future price higher than S price, okay? So this is what we call normal market, contango. Okay, and then still following the same rules at the end, if there is no arbitrage opportunity, expected value at ST would equals to S0, ERT would equals to F0. Okay, it's just that the process of convergence is the same, but they are starting with different stages. So far so good? Okay. Now, if there is no arbitrage opportunity, then we will expect in the end, at time t, okay, the future prices will converge together with the spot price at the time t. Okay, here the condition is when there is no arbitrage opportunity. Okay, but what if they are different? So when they are different, and then it will incur what we say as the basis risk. Okay, So basis risk means that when EST not equals to F0. Theoretically, they should be the same, but in the end, you find they are different. Are we okay with that? Okay, so obviously, they will have some arbitrage alternative existed because there are some reason to bring them becomes imperative. Okay. Now there are two terms you have to remember, and you don't want to get confused. Okay. Basis risk 叫基差风险 is a risk. Okay. And basically, the key point of basis risk coming from differences between spot and futures or forwards position. Okay, I'll write down here. So there are a lot of factors could bring the basis risk because it's the differences between your spot position and the forward or futures contract you have. Okay, so it could have a many reason to bring the basis risk. For instance, price differences. Okay, ST different than FT, that's the price differences. Secondly, the time differences. Okay, because that we want to use a futures contract to S2 minus F2. We just learned it. Basis, right? Okay, so it will equals to basis plus F1, right? Or F1 plus basis, that's the same thing. Are we okay with that? Yeah? Just rearrange the formula. Guys, this is very important, okay? Because in the end, you will remember the formula. This is the formula for the effective price. So first of all, if you have a long hedge in the spot market at time 2, which is the time T, your cost is S2 in the spot market. And you have a gain from your hedging position, F2 minus F1, right? If you open the brackets, it becomes S2 minus F2 plus F1. Remember, this part here is the basis, right? So using the basis into your formula becomes B2 plus F1 is here. Or F1 plus B2. Can you guys follow me? Okay, so now, just remember before you go away, okay, because we're gonna use this to practice questions. F1 plus basis 2 is the effective price for long hedge. And then from the perspective, the cost you pay. Are we okay so far? Yeah? Okay, we can follow this, right? If that's okay, let's try out this example here. I'm gonna continue, yeah? If you don't have time to take down the notes, don't worry, I'll put up this online later, okay? Okay, okay, now take a look at this example. So it's a long hedge example, okay? On June the 8th, a firm knows that it will purchase. Remember, all the buy purchase come with the long hedge, okay? 20,000 barrels of crude oil in October. And then we have all this price information, all right? So first of all, let's draw the diagrams. So if you want to buy, you have a long hedge, right? Long futures to hedge, right? And then let's draw the diagrams for all the prices on your payoff graph, okay? So you have a F1, remember F1 is your exercise price. F1 is here, okay? F1 according to the information is 68. Okay, and then here you have F2. 69.1. And then you have a 70, which is your S2. Okay? Now, remember, you are constructing a long hedge you're expecting to buy in the future. So this effective price is literally your purchasing cost in the end, right? Are we okay with that? Okay. So now, effective price do you remember our formula? Yeah. Right? Okay. So it's F1 plus B2, right? So equals to F1 plus S2 minus F2. Agree? So you can open the brackets. F1 plus S2 minus F2. So what equals to 68 plus 70 minus 69.1. Agree? So the answer would be 68.9. What does that mean? It means after hedging, your total effective cost is $68.9, okay? But remember, that's per unit, right? So per barrel. How much do you buy? 20,000, right? So the total cost would equals to 68.9 times 20,000. Okay, so come up with 138,000. That's the answer. Okay. Are we okay so far? From now on, every week is a hardcore. Please don't skip the class, okay? This is not this. This is simple. Our tutorial is difficult, okay? And next week we're gonna go into the options, totally different from here. So we are having different things every week. Try not to skip the class. Okay, that's all right. Let's continue. Okay, next one, short hedge. So remember, yeah, short hedge come with the sell. So if you sell something, it's an income, right? Okay, we can draw the diagrams now. So if you draw diagrams, I'm just focusing on your hedging position, okay? Because we want to come up with the effective price. So you have a short hedge, and then that's your futures position, your derivatives position, okay? But in the meantime, you would remember it implies that you have a long spot, right? Agree? You have a long spot. That's why you do the short hedge. It goes together, right? Okay. Now, putting up the effective price. When you sign the short futures contracts, again, the exercise price is F1. Okay? F1 is your exercise price. Okay? And then you will earn money when the price end up with F2, that's at the time T, right? Lower than F1, right? So your selling price is higher. And then in the same time, at time T, you go on to sell your spot, right? So the selling price you sell, S2 is here. We finish this and then I'll have a break. Okay, we will continue. So remember, that's a short hedge. Okay, so let's take a look of all the price quotation. F1 is your exercise price, remember? F2 is the market price at the time when you sell your product. So that's the time 2 or time T, okay, at maturity. S2 is how much you sell in the spot market, okay? So basically that's at the time T as well, okay? Remember, that's your income, right? When you harvest, you sell this to the market at S2. Are we okay with that? Yeah? Now, B2, the same definition, okay? But today, it becomes an income, okay? So B2, remember, yeah? Equals to S2 minus F2. Very important. The definition of basis is all the time the same, no matter you have a long or short hedge. Okay, equals to S2 minus F2. That's the B2. Okay, now take a look of our table here. Price of an asset is S2. Remember, that's the selling price. So that's the income. Okay, this is the effective price for short hedge. But that's your income, okay? Instead of cost, it becomes an income. You will gain on the futures, that's your hedging position. So take a look of red line here. Your gain in the futures equals to F1 minus F2, agree? Right? F1 minus F2 is here. That's your gain from the futures position, right? Okay. Now, how much is your effective price? So the third line here is your formula, all right? Effective price. So let me ask you, effective price. That's the gain, right? The income. You sell your spot as S2, and then you gain from your futures position, okay, as F1 minus F2. Okay, plus or minus? It should be plus or minus? Plus, right? Because you sell your products in the spot as S2, right? In the same time, you earn money in the futures, right? So it will increase your income. Agree? So here, very good, it's a plus. It's different idea from previous one, right? Previous one, you again will reduce the cost. So it's a minus, okay? Now, because it's an income, so you again will increase your income. Are we okay with that? Okay. Now, open the brackets. Becomes S2 plus F1 minus F2. You can rearrange, becomes S2 minus F2 plus F1, right? So becomes B2 plus F1 or F1 plus B2. Did you find it's actually the same formula? Right? Okay, you have to remember this by heart, okay? Actually, the same formula, but it's an income. Okay, for the long hedge and the short hedge, most important is this formula. We want to continue to talk about that, how do we use futures or forward to hedge, okay? The previous two examples, you see, we have a long hedge and short hedge, right? And the two examples I tell you, like the first one, you are actually hedging with exactly the same products, right? Like crude oil, okay? You are using crude oil futures to hedge your spot position in the crude oil, the same products, all right? And then in the short hedge positions, you are using the same currencies, like Japanese yen in exchange for US dollar, okay? But sometimes, unfortunately, if you want to hedge, you cannot find a perfectly matched futures positions. For instance, that if you are airline company, airplane, okay, the oil that you use is the airline, like airplane oil, right? Like fuel or petrol, right? Like petrol. However, if you go on to the futures market, maybe there is no futures on flight petrol, but there are futures contract on heating oil, on the crude oil, okay? Similar to the flight oil, but not exactly the same. Can you guys follow me? Okay. So occasionally there is cases that the futures contract you use may not be 100% identical to the underlying position you have. Okay, so this is what we say choice of the contract. In that case, you have to choose the one has the highest correlation to your underlines. Okay, so basically, if not 100% identical, okay, choose futures with highest correlation, which is the tau. Can you guys follow me? Okay. So in that case, we have to adjust the number of contracts. Okay. And actually, we learned that before already. That's the hedge ratio. Okay. So hedge ratio is to adjust the number of contracts. Okay. So first of all, take a look at the first point. It's related to the hedging horizon. Okay. Choose a delivery month that is as close as possible, but later than the end of life for your hedge. Okay. So when there are some bases, which means difference in time, you have to do the fully hedge, then the contract you choose have to be longer than the time you want to hedge. Agree? Okay? To be able to hedge, right? For periods. Okay. Secondly, when there is no contracts on the asset being hedged, choose the contract whose futures price is mostly highly correlated. Remember this? So we are looking at the correlation coefficient, okay, between the two parties. Do you know how to estimate correlation coefficient? So remember, equals to, you all learned the statistics before, right? Covariance SF divided by sigma S times sigma F, okay? Remember, okay? So this is how we measure the correlation between the two contracts, okay? And then with the asset price, okay? So there are then the two components to basis. So you have a two basis risk. One is time basis risk, and secondly is the price basis risk. Okay, this price only also referred to as the quality, right? Because S and F are different. Agree? Okay, so in that case, we're trying to figure out the most close futures position to hedge. But if your underlying has higher price risk compared with futures, in that case, you have to hedge more because your spot position is more riskier. On the other hand, if your spot position is less volatile, sigma S is lower, okay, compared with the futures price volatility, then you can hedge less, right? Okay, so we are using the correlation and their relative risk to adjust your hedge ratio. Right, so let's take a look. Actually, I think we've done this before, but here is just like more specific, and then we look in more depth about this, okay? So first of all, optimum hedge ratio. This is the H star, okay? And in the CFA, sometimes they say HR, okay? H stands for hedge, R stands for ratio. We okay so far? Okay, so hedge ratio definition is proportional exposure that should be optimally being hedged, okay? So equals to correlation, I think here has the definition, okay? Correlation between the spot price and change of the futures price, okay? And here, tau would equals to covariance SF, okay, over sigma S times sigma F. You have to remember the tau formula because occasionally the question will give you the covariance directly for us to estimate the tau ourselves, okay? right? So this is the hedge ratio, and then that's the correlation coefficient, 相关系数, okay? And that's the standard deviation for spot return. And that's the standard deviation, STDV here, okay, standard deviation for futures return. Okay, so obviously, if your spot is the same as your futures, for instance, you are using SP500 index futures to hedge SP500 ETF, they are the same, right? So basically, top and down equals to 1, correlation equals to 1, your hedge ratio will equal to 1, right? You don't have to adjust. But if your spot position risk is higher, then your hedge ratio will be higher. That means you have to long or short more futures in order to hedge your risk, okay? So basically, here very important, yeah? Please write down. Sigma S goes up, H will go up. Because H is related to how many countries you will hedge, okay? So this is related to, for us to compute it, how many countries we want to buy or short, okay? So if your risk in a spot position going down, then your hedge ratio will go down as well, okay? So very important factors. Okay, so if that's all right, let's continue, yeah? So I think financially you have to understand sigma S also related to the volatility, 这就是波动性, okay, of the spot price or returns. Okay, and that's the volatility of the futures. So obviously, when the volatility is higher, then you have to hedge more, right? So hedge ratio will be higher. You guys what I mean? Yeah, important idea, okay? Now, we're gonna use the hedge ratio to compute your number of contracts, okay? But before we start it, I also want to introduce another idea or concept, the concept called the optimal tailing the hedge, okay? 叫避险回调 tailing the hedge. Okay, now, tailing the hedge means that you are using not just the quantity of the asset compared with quantity of the futures, but also you adjust in the price of the asset and then price of the futures. Okay, Q stands for the size, so that means quantity, 数量. Right? Okay. V is the value. Okay, now very important. Q times P equals to value, agree? Right? 1 pen costs me $10. 3 pens cost me how much? $30, right? So 3 times 10, quantity times the price. You guys follow me? Okay? So value of the asset equals to Q times P. Are we okay with that? Yeah? So write it down here. This equals to QA times PA, and this equals to QF times PF. Okay? So tailing the hedge is here. Originally, when we compute how many contracts we want to hedge, you can only use the quantity. Like before, you want to hedge for 20,000 barrels, and then you just use 20,000, right? But now, you want to adjust the price differences as well, okay? So after we adjust the price differences, becomes the value, okay? So in that case, it becomes H star times PA times QA, and here is PF times QF, okay? This formula here is what we call tailing hedge, okay? And then basically you can computing your hedge contracts, okay, number of contract by method 1 and method 2 to choose the optimum contract you should long or hedge. Are we okay with that? Okay. So first of all, look at here. Now I want to go into more detail, right? Before, you only draw the diagrams. But do we go into how many contracts, too short or too long? No. Okay. Now we're gonna compute exact number. Okay. So before you compute exact number, you do the first formula first to figure out the hedge ratio. Okay. And then after you figure out the hedge ratio here, that's come from the previous formula, right? And then compare with the size you want to hedge with the size of the futures contracts. Okay, so that's the first hedging number of the contracts. And then you go into more detail to double check with the price as well. Okay, so that's what we call tailing hedge. 我语叫记得哦，避险微调。Okay, tailing hedge to adjust with the relative price as well. Okay, and then you can choose between the number of these two, the optimum hedge number of the contracts. Can you guys follow me? Okay, if that's okay, let's try to execute this example. So, airline will purchase. In the end, it becomes automatic, right? So if you purchase something, long hedge or short hedge? Yeah, long hedge. Okay, remember, purchase go with the long hedge, right? We really have to spend some time to do revision, all right? Otherwise, I'm very worried. I don't want to see you guys again next semester on the same course. Okay, so that's a long hedge. Okay, they all go together, right? So purchase 2 million gallons of jet fuel in 1 month and hedge using heating oil. You see, so they are hedging the jet oil with the heating oil. Obviously, they are not the same, right? So you have to use the correlation to adjust. Okay, so the correlation between the two contracts is 0.928. Hedge ratio equals to tau times sigma s over sigma f, right? So here sigma f is 0.0313, or sigma s is 0.0262. So you can adjust that, equals to 0.777. What does it mean? You can see that the spot, this is your jet oil, okay? Volatility is lower than your heating oil in futures. So it comes out that you don't have to hedge that much, right? Are we okay with that? Okay, the hedge ratio is lower, okay? So you come up with the hedge ratio, and then how much is the number of the contract we should long, all right? So the size of one heating oil contract, remember, yeah, that's the future contract size. Is 42,000 gallons, okay? And then the question say 2 million, that's our spot, right? Okay, so here, QA equals to 2 million gallons. And then QF equals to 42 gallons. Okay with that? Yeah? Okay. Now, spot price is 1.94. Here is the PA. A stands for asset. So it's the current spot price. Okay? And then futures price stands for PF. Okay? So basically, VA would be equals to PA times QA. Agree? And then VF equals to PF times QF. Are we okay so far? Yeah? Okay? So optimum number, 2 ways, right? The second way, this is the second way for tailing the hedge. The first way, here I write down, I don't have the space. Okay, I write down here. Is H star times QA over QF, right? That's our original number of contracts. Okay, so equals to H star is 0.7777 times QA is 2 million over QF is 42,000. Agree? Equals to 37.03. Now, first question is not a perfect answer, okay? So we should adjust that. There is no 0.03 contract, right? So you have to round up or round down, okay? It's more close to 37. But if you only do 37, you're under hedged because 0.03 you don't hedge, right? Okay, but it's up to you. Anyways, you have to choose the full number, okay? Question, long or short? You long or you short, Laura? I'll give you a hint. You purchase, so long or short? Long, very good, okay? Remember this by heart. If you purchase, you are long, okay? Long hedge, okay? Now, secondly, with the tailing the hedge, okay? H star times VA over VF equals to H star times QA times PA over QF times PF. Agree? Okay, so here we compute the VA, VF here already. Okay, so this is VA, this is VF. Agree? Okay, come up with 36.0. Okay, so in that case, more than that, you can say 36 long. Okay, but if you combine the two together, actually maybe you'll come to a conclusion you should learn. They are both close to 37, right? One is 36 something, one is 37.03. So maybe long 37 is more safe, right? So 1 and 2 help us to verify which one number is better. Okay? Can you guys follow me? Okay, so that's the tailing the hedge. Remember, yeah? If that's okay, we will continue. Okay, so let's continue with these cases. In case I forget, right? Next week, please bring this one, okay? The tutorial I put online already. Did you see that? This is the Word file, okay? And also, please bring the option trading strategy. Did I upload it online? I think I did, right? Option trading strategy. This one. Okay? And for the option trading strategy, we have a tutorial as well. Oh, I forgot to put here. I'll show you now. Like, I will put here are maybe around 10 questions, okay, on trading strategies. 我考试试着从里面出就好了。Okay, so this one maybe bring next week as well, option trading strategy. I haven't put online, but I will do that maybe in this couple of days. Okay, another PPT file. So from now on, we have tutorial, okay? Tutorial on futures, tutorial on the option trading strategies, okay? To help you to prepare the exam. Are we okay with that? Yeah? Okay, so let's continue. It's here. Okay, suppose that the standard deviation of quarterly change in the price commodity is 0.65. So remember, that's the sigma S. When you read the question, be careful, okay? Standard deviation for quarterly changes in futures is 0.81. So that's the futures, right? So that's sigma F, okay? And the coefficient correlation between the two is 0.8, that's the tau. So what's the optimum hedge ratio for 3 months contracts? And what does it mean? Okay, so hedge ratio equals to tau times sigma S times sigma F, because they are different, right? So it equals to 0.8 times 0.65 over 0.81, right? So the answer would be 0.642. Okay, so what does it mean? When you buy or sell 1 unit of spot, okay, you will use 0.642 unit of futures to hedge. That's the meaning of hedge ratio. Because here again, the risk of spot position is lower, right? 0.65 compared with the futures position. So when you use these futures to hedge, you don't have to hedge that much. Okay, so that's why the hedge ratio decreases. Are we okay with that? Okay, so you can imagine that when sigma S is higher, then the hedge ratio will be higher as well, right? You have to use more units of futures to hedge. Are we okay with that? Okay, good. Okay, next slide still, I put the answer here. Okay, so you can kind of double check with that. All right, okay, finally, I think we tried this kind of question before as well. This is related to the using index futures to hedge your portfolio, right? So to hedge the risk of portfolio, we need to figure out the correlation between your portfolio and the underlying index futures, right? So that's the beta, is the linear correlation, right? Instead of a tau. Okay, so beta is the linear correlation between VA and VF. Okay, beta 线性相关. Okay, so that's how you computed your hedge ratio or number of contracts. Okay, now VA is the value of portfolio. VF is the value of index futures. So, if you still remember our definition of the beta from the portfolio theory, right? When your portfolio has beta higher than 1, that's the active portfolio, right? Beta equals to 1 means index tracking. So that means you have the same risk as the market, okay? When beta is lower than 1, that's the passive portfolio. So when your risk is lower, you don't have to hedge that much. So actually similar idea to the hedge ratio we just learned, right? If your portfolio is highly risky, beta is higher than 1, then you want to use the index future, you should short more because portfolio normally is the long position. Are we okay with that? Okay. Good. Now, very importantly, remember this formula here. If you want to come up with the value of the futures contracts, you use the index quotation multiplied by index value per point, right? We need the IVP, remember? Okay? Index is each point, and you need the IBP to come up with your contract size. Okay? If that's the case, let's continue with this example here. Take a look. Okay, futures price, that's futures, okay? For the SP 500 is 1,000 points, right? Remember, index is in points. Size of the portfolio, 5 million, remember that's the VA, okay? Put down the formula here, equals to beta times VA over VF, okay? And then beta of portfolio is 1.5. Contracts is $250 times the index. What does that mean? That means this is the IVP, right? Index value per points. Okay, so what position in the futures contract on SP 500 is necessary to hedge the portfolio? Okay, now very importantly, like currently our portfolio beta is 1.5. So you can actually fully hedge your systematic risk by making beta equals to 0. That's your target, okay? But alternatively, you can use the futures contract to increase or decrease your beta as well, okay? So that's the adjustment. So later on, actually, we kind of amended our formula to improve it, okay? So you can improve your formula by beta star minus beta, okay, times VA over VF. And then beta star equals your target beta, okay? And then without the star is your old beta. Okay, so the reformed formula allowed us to adjust your systematic risk, okay? What position in the futures contracts, okay, on SP 500 is necessary to hedge? So here the first answer is pretty straightforward if you think you want to do the fully hedge. Okay, so it equals to 1.5 times 5 million over 250 times 1,000, right? Agree? Right? And then the answer you should short. 天哪，这题我没算，帮我按一下。还是我算。不止你们晕，我有点晕了。Okay, I did it. 250,000. I did. Okay. Hang on. So the answer is 30 contracts. All right. So very importantly, if you go on to short 30 contract, your goal is to make, if that's fully hedged, right? Your goal is to make your beta equals to 0. Okay? So that means if I draw a diagram, you have a long portfolio, right? And then you go on to short index futures to hedge. Can you guys follow me? Okay, so minus 30 contracts, short 30 contract means that you are fully hedged your underlying risk. So as a consequences, the portfolio beta would equals to 0 after you go on to short 30 contracts. Are we okay with that? Okay. Now, the question is though, what about you don't want to fully hedge, but you want to hedge the, change the beta, okay? So you want to adjust the beta. Now, remember, yeah? What position is necessary to decrease the beta to 0.75, or the other question, what position to increase the beta? This is our beta star. That's your target beta, okay? You want to modify your target beta. So in that case, your number of contracts, okay, becomes the new formula, beta star minus your old beta times VA over BF. Okay, and remember one thing very importantly, yeah? If you come up with a positive number, that means you go on to long. If you come up with a negative number, that means you go on to short. Are we okay with that? Yeah? So actually this formula is better because from the sign, you can conclude whether you should long the contracts or short the futures contracts. Okay? Yeah, I compute it here. Okay, now I'll do it here. Okay, so question 1. Just write down our background information. VA is 5 million. Okay, VF equals to 1 to 50 times. Okay, 1,000. 1,000 times 250. That's the IVP. Okay, and then old beta equals to 1.5, right? That's our original setting. Agreed? Okay, so question 1. Okay, when beta star equals to 0.75, okay, so number of a contract equals to 0.75 minus, remember originally your beta is 1.5. It's not 1, okay? Original beta from previous question is 1.5. So times 5 million at the top, that's your VA, right? Divided by 250,000. That's the VF. Okay, so you come up with minus 15. Okay, that means short 15 contract. That's the first question. Okay, so you don't want to fully hedge. Instead, you just want to lower your beta because maybe you think the market is very risky now, so you want to become more passive. Okay, and secondly, your beta star equals to 2. That means you want to make your portfolio more aggressive, right? Okay, so in that case, number of a contract equals to 2 minus 1.5 times 5 million over 250, right? So you find out it's positive, guys. Pay attention to here. So instead of short, actually you long 10 contract. What does it mean? Because you want your portfolio to be even more riskier. Maybe market is going up, right? So instead of a short futures, you have a long spot plus long futures. So it becomes, overall portfolio becomes very aggressive, right? Okay? To increase your systematic risk. Are we okay with that? Yeah? Okay. I think we can have a break now. Okay, so that's it for today. I'll see you guys next week. Do you want me to upload it today for the note or wait until next week? Yes? Okay, I'll do it today. Yeah.